Welcome to another episode of Deal Flow Friday. I'm your host, Moghavem, and we got Max and Mitch back on the pod.
We're excited to be back.
Great to be back.
Yes, exactly. From the beginning of the year, we had a good predictions of what we think 2025 is going to be. And here we are almost halfway in. So it's, I guess, good to have a little bit of a recap. So, first of all, how you guys feeling?
Feel good.
Yeah,
Feel good, yeah.
feeling good about the year?
I mean, it's been a little choppy with
For sure.
everything, with the tariffs and who knows what's going on with interest rates.
Yeah, and there's now this announcement, I think it's happening right now, that Trump is, meeting with the UK maybe.
Yeah, right. It should be interesting to see what the framework of that is because I'm sure a lot of the other countries will analog off that framework. That'll probably set like the precedent for what the template is for
Yeah,
these trade deals.
yeah, exactly.
Yesterday was the Fed meeting, and Powell said we might have inflation, we might have a recession. So whatever that means.
Yeah, and we're gonna dive into that too. Max, I guess we'll jump into that first. I have some quotes here from episode 1, so it'll be fun to read the predictions. We have the receipts. Max, episode 1. And I quote, you said, the tariff thing. It seems to me like the crowd is saying tariffs are inflationary, which they definitely are in the very, very short term. But at the same time, when prices on products rise, that brings down demand, which will theoretically hurt the economy because products will get more expensive and the demand for products will go down. So the sales of those products will go down. That's more recessionary than inflationary, and that can actually help interest rates. Do you still believe that?
I do.
Yeah.
And
So let's expand on that.
I think the capital markets support my thesis, right?
Mhm.
At that time, I was definitely in the minority on that, and everybody was screaming at the top of their lungs, inflationary, inflationary. But with what's going on and with what CEOs are saying, is we're going to have to cut jobs. We can't do this here. The tariffs aren't going to work. I think that I was in fact correct that if you tax something, whatever that product is, the demand on that product goes down. So if the demand on a product goes down, you don't need as many jobs to create that product and sell that product and support that product. So it's recessionary. And that's why Powell said what he said yesterday, where yes, you'll have inflation, but yes, it can also hurt the economy. So it's a little bit of both, but it's not real inflation, right? It's just a temporary price increase. And then again, it could do a lot of harm. But then there's also, of course, the theory that maybe it can incentivize certain American manufacturing, but that's a whole other conversation. So yeah, it's not just entirely inflationary. Just I think that's an all too simplistic way of looking at it of tariff means price goes up, that's inflation. And
Yeah.
therefore they can't cut rates. It's not that simple.
Yeah, and I think the biggest takeaway from since Liberation Day was uncertainty, and uncertainty is lowering consumer confidence, which, as you said, is recessionary. No one wants the economy to get into a recession, but I think you're seeing that this tariff talk is more a lowering of consumer confidence than it is an increase in prices that's inflationary.
Correct.
So I think that's totally, totally right in that regard. Mitch, how are you feeling about this tariffs in regards to multifamily? How do you think it's going to impact multifamily overall?
I mean, I think you have to look a little bit deeper into sector by sector. I think what Max is saying, is interesting, but I think you got to look at it in sector by sector. I mean, for example, sure, can you have screwdrivers that are coming from China now they're taxed, 130, 140%? Is the demand for those going to go down? Sure, but end of the day, there's still a big construction business. There's a lot of people that still need screwdrivers. And I just read an article a few days ago about how a few American companies have quadrupled or quintupled the production of screwdrivers and other materials because the market still needs that stuff. So that is inflationary, right? For example, in terms of multifamily, Canada, if you look at the import export, I think they're down almost 5.5, 6%. We haven't seen that since kind of the COVID days. So Canada being one of the biggest lumber exporters to the United States, that's going to have an impact on construction costs, which is good for us, right? Because we're not really doing any development right now, but it's good for our existing product. So I think it depends sector by sector, and is impacting but the market. But overall, I feel pretty good being a multifamily owner right now because that is having a effect on construction costs, which are still pretty high. You can't really build multifamily for less than, 325, 340 a foot. That's what it's going for. So you're not having as much development happening right now, which is good for us because you're not having so much supply.
Yeah, and I think the supply already kind of tapered off before the tariffs. I think borrowing costs really was even more dramatic to cost of capital than tariffs are right now. I think tariffs is almost like the nail in the coffin with supply. I think supply you already saw to see come down, which we were all looking forward to when you had this glut of supply hit the market and you started seeing our own operations start to take a hit with concessions, with bad debt. So I think tariffs does help that in the regard, but it's not really the impact that maybe some would say, because I think the interest rates really had even more of an impact. And I think even just if there were tariffs still in place, but interest rates were to come down, I think you'll still see a little bit more supply happen even with tariffs.
Yeah, I agree. I
Yeah.
agree. I mean, look, the interest rates are the big one. That's
Yeah.
the wild card in here. And look what's happened with long-term rates. They came down substantially when Trump became president, and then they went back up. So it's tough to kind of predict, short-term rates or long-term rates, but they're bouncing back and forth, and they're kind of where they were before Trump, came into office.
Yeah, and going to interest rates, the audience, especially Omar, loves that, Max, that you always predict how many rate cuts there are in a year. So, well, I want to give the audience what they want. January 1st, you said that there would be more than two cuts this year. I think you predicted three or four. Do you think there's still going to be more than two cuts this year?
As we sit here today, May 8th, 2025, yes, I do think that there are going to be more cuts. I feel more confident there are going to be more cuts because of everything that's going on with tariffs and inflation coming down. I think that we saw the GDP contract first quarter. There are some indicators showing that the economy is weakening and there is less inflation. So you also had Powell, I think 4 or 5 weeks ago, say that we are moderately restrictive right now, which in layman's terms means rates are higher than they need to be. And based on all of that, yes, I firmly stand by 3 or 4 cuts this year. When they start, I don't know. We were all hoping for June cuts, and on the CME, the Chicago Mercantile Exchange, which is the futures markets where people bet on when that's going to happen. As of 2 days ago, it was a 65% probability for a June rate cut, which is now unfortunately about 20%. So it looks like we're likely not going to get a June rate cut based on what the Fed said yesterday. Could it happen in July? Possible. August, we have a break, and I would say by September for sure. I actually heard one analyst this morning calling it a football season rate cut cycle, kind of like
Exactly.
last year. So will we have a football season rate cut cycle? I don't know. We'll see. But I think we will have 3 to 4 cuts.
Yeah, I think,
Let me add one more thing.
yeah,
Let
sure.
me add one more thing to that is Bank of Canada, 2 and 3 quarters, they're cutting. Bank of England cut this morning. They're around 4. People's Bank of China, they're cutting. I don't know the rate. European Central Bank,
Cut last month.
yep, they're at 2 and 1/4. So we're behind the 8 ball. And all of the other central banks, or at least the ones that I mentioned, they're being much more proactive and trying to get ahead of it. Our central bank is being a little more reactive. They want to see what's in the data.
I think from also, to be fair, like from the tariff policy, right? I think the uncertainty kind of shook things up where it's like, are tariffs being inflationary going to seep in, or is the consumer confidence, which is more recessionary, going to seep in more? And I think that's where you said the Fed is a little bit more reactionary because they're kind of waiting and seeing what the data comes out after this kind of post-liberation.
Well, the
Yeah.
Bank of England said this morning, 25 basis points this morning, based on the fact that they're concerned with what will happen with the global trade war,
Mhm.
right? So they're being proactive. They're saying we're concerned what may happen in the future.
Right.
Where our Fed is saying we want to see the data before
Mhm.
we do anything. So they're more reactive.
Right.
Whatever.
Yeah. It's good to talk about. Obviously, we don't have a crystal ball, but it's good to talk about and think about as we structure our own investment strategies. Has anything changed from an investment strategy standpoint from January till now on what type of vintage, what type of assets, if nothing's changed, maybe reiterating what we're doubling down on as we're kind of almost halfway into the year.
Sure. I'll talk about a few things. I mean, look, I think overall it's pretty tough to raise institutional equity right now. Talking to a number of our partners and other groups that we've worked in the past, it's pretty tough to get a deal past investment committee. Like most of the groups tell me it's got to be, the no-brainer of no-brainers. So a lot of times what you're seeing in today's market is we're just not seeing the rent premiums for renovations that we saw in the last 4 or 5 years, right? You're not really seeing value add deals where you can get 250 to 350 on a value add per unit if you spend 12 to 15,000 a door. You just don't see those deals today, but you are seeing some deals that have some upside, and you start looking at a cost basis, an in-place cap rate basis, and it makes sense. It's still tough to get people to put some chips on the table. I think there's certain markets, and we'll talk about it as well, where you're starting to see some more activity being in Northern California, maybe even in the Pacific Northwest, where people are starting to come in and looking at a basis play and feeling better about investing in those markets. And at the same time, you're starting to see there's a lot of political risk. Washington just passed,
Hmm.
statewide rent control similar to Oregon. You got to be mindful of all these different things. But I think overall, you're starting to see more opportunities. And I feel like people are ready to jump back in. It's just finding that right deal that is newer vintage, maybe, 2000 plus or 90s. I think people are really shying away from 70s, and even that extra in place cap rate that those deals are able to get you. People are really not moving forward with that product type unless it's a no-brainer, right?
Yeah.
So it's tough to find, and you can, add your color, but it's tough to find 90s plus, 2000 plus with a healthy cap rate pretty close to where you're financing from the agencies, and you're going to increase the stabilized rock by 125 to 150 basis points.
Yeah, that rock is just that spread between in place and rock is just like not as existent from a
Right.
typical value add strategy. There's ways to get creative potentially with abatements and but it's just not there anymore from like a simple renovating. It could maybe be there down the line, but with all this supply and all this, yeah, supply hitting the market, it's just been a lot tougher to find that spread. I think even more of our yield on costs are lower than the in place cap because we're seeing gain to leases, and we're seeing bad debt starting to creep up and operations starting to deteriorate. So I think you're right. It's harder to get those investors off the sideline. But I think when you see through the numbers, you can see and you take a step back, you're like, this could be a good buying opportunity.
Well, I think most groups are feeling this is the bottom right now.
Hmm.
Brookfield just announced yesterday, it was all over the press, they raised in at the first quarter almost 4 billion plus of equity to buy commercial multifamily and other product types. So I think they're going in aggressively and buying. So once you start hearing household names like, you know, Brookfield and Blackstone, and they're putting chips on the table, you're going to see more groups invest in multifamily in these markets.
Yeah. Max, anything to add on kind of investment strategy?
Yeah, if we're just talking about the country as a whole, I think a lot of people right now are talking about the Midwest. I would say, from a contrarian perspective, I probably wouldn't go to the Midwest at this point because it's pretty heated. I hear from a friend of mine who's pretty heavily invested in Columbus, Ohio, that Columbus is now trading in the four caps.
Yeah, the party's over. I think,
Party is over
yeah,
in Columbus.
yeah.
It feels like Boise felt right before
Hmm.
COVID in
Exactly.
2021.
Exactly.
Everybody was calling me, like my dentist, my friends who are in other businesses. Hey, what's going on at Boise?
Yeah.
That's when you know it's over,
Yeah.
right? That's Columbus right now.
Yeah.
And then other parts
What
of
was
the
that, clip from The Big Short where the stripper had, like, 10 houses and it's like, "Put a short everything, short everything."
absolutely,
Yeah.
you can draw a direct line between 11 and Columbus,
Yeah.
Ohio. This is not a family-friendly podcast.
Yeah.
Anyways, Um, and then you have all this wonderful rent growth, right? And
Yeah.
everyone's bullish. Everyone loves the Midwest because of all this rent growth. It's stable. It's a good insurance market,
Mhm.
right? The Sun Belt's getting killed. The West Coast has the politics. I would go the other direction. I think, there's an old saying, fish needs to swim, developers need to build. Developers are going to find that opportunity. And what the Sun Belt went through in I think, 2020 through going through now, basically,
Yeah.
with supply, because Sunbelt has had just an unbelievable amount of growth, right? It continues to have population growth and has those fundamentals. The Midwest doesn't. So when they start to develop there, it's probably going to be pretty slow to absorb and can affect fundamentals for longer than some other places in the country, like California, New York, Sunbelt, right? So I'd be really careful with the Midwest.
At this point, right?
Yep.
I think, when you enter a market that has high rent growth, high demand, but low barriers to entry to build, that's where you gotta be careful because once demand starts, the supply follows. And so I think you're kind of later in the cycle at this point with the Midwest to enter now because you're just gonna be running into some supply.
Yeah. And if you think about it, what is the Midwest, with all due respect, what does the Midwest really have going for it comparable to, let's say, the Sun Belt or the coasts? California, New York, they have the best jobs, the highest incomes. They're super supply constrained. The Sun Belt has unbelievable immigration. They have fantastic weather and tech, and they do have great jobs, not as good as California and New York. Great jobs. Income is growing, very business friendly, right? So you've got all these amazing reasons to buy, whereas the Midwest just didn't, they don't have the immigration. They don't have the jobs that pay like Google and Facebook on the West or in Saks.
It had the yield. It had the
It
yield,
had the yield and
which
it had the rent growth. Both of those are, so the yield's gone and the rent growth is going away. So I would not invest there for those reasons. And on the flip side, where I'm bullish, again, going more contrarian, not contrarian, I think the Sun Belt will absorb, recover fast, right? Like we own, unfortunately, only one property in Miami. We don't have any concessions. It's one of the only markets in the country where we have no concessions. Rents are stable, big, big
insurance is coming down.
insurance is coming down, big top of the funnel, always getting a lot of calls and tours, and you have in migration, you have absorption. So really, really strong, right? And I think the other markets that are a little overbuilt, like Orlando, I mean, we're totally fine in Orlando. Some of these markets are overbuilt, they're absorbing. You have a lot of migration. And then West Coast, I think I said it um, in our Q1 pod, is that I'm long West Coast this year, and I continue to remain bullish West Coast. And we're trying to buy back in our old markets in the West Coast, so long West Coast.
Yeah, let's stay on West Coast for a bit. You called it that you were, Trion, we're focused on West Coast and you're bullish on West Coast. Since then, there's been the wildfires in LA. There was an eviction moratorium in LA. I know West Coast is more than just LA. A lot of people are nervous about the political risk. As Mitch mentioned, Washington just passed rent control. I don't think that rent control is so prohibitive, but just having rent control being passed makes people nervous because it opens the door for worse. Always starts with, the 12% and then it gets a little more prohibitive. So, what do you have to say about the West Coast of what's keeping you bullish overall?
So to your point, the West Coast is not all LA, right? So you've got great markets surrounding LA, although those cap rates are very compressed. And
Like in the IE, you're saying?
i.e., Orange County, San
Mhm,
Diego,
mhm.
those are very compressed cap rates, and I don't know if there's much room to go down further. NorCal, I think, looks really interesting. You've got some, again, going back to jobs, you've got some of the best jobs in the world, very supply constrained. Migration patterns tend to seem to have settled a little bit. I think we're probably looking at rent growth back half of this year and into next year. Pac Northwest, we're not really in Seattle. I'm not going to comment on Seattle. I know they've had immigration. I think they're a top 10 city again for immigration, probably the only one on the West Coast, which is interesting. They have a lot of supply. They have the political issues. You have the exit transfer tax. It's impossible to evict in the winter. Do with that what you will.
Yeah.
We've been in Portland for probably 10-ish years now, maybe a little more. And I think Portland seems super interesting, right? There's no supply. You're starting to see the politics change. That downtown Portland's getting cleaner. We're in the burbs, and our properties are performing very, very well. So we would love to, hold on to our properties as long as we can there and continue to build a portfolio there because it just seems like it's about.
Yeah, it's actually interesting when pre-rate hike, when people were picking markets, they were solely looking at inbound migration and kind of chasing the Boise's and the Sun Belts. And you even saw like a chart from 2020 to 2024. Most of that inbound migration was like in the Sun Belt, Texas, Florida. What you saw that followed was all the supply And now you're seeing where places that are maybe rent control or supply constrained are performing much better today because they didn't get prohibited by some of like the supply that hit the market. So Portland, Bay Area, supply constrained areas, they're the ones that the vacancy is still, in the 5% range. There's little to no bad debt. People are paying rent, and you're just seeing better operations than some of these other markets are in.
That's right. That's right. Much, much better operations.
Yeah.
There's something to be said for being supply constrained during a downturn.
Yeah. It's true. We were talking about it in the beginning of the year, and now we're seeing in 2025. I mean, at least what I'm seeing is that lenders are not willing to work out as much this year as they were the past 2 years. Everyone was kind of kicking the can to 2025, and here we are. Are you guys starting to see a little bit more distress coming online than what you typically saw in the past couple of years? Do you think the wave of distress is starting to come? Maybe it's geography by geography. What are your guys' take on what you're seeing halfway into the year?
I think look, I could tell you, talking to peers in the industry, lenders definitely have a different, perception of the market. And I think, extend to till 25. Here we are. I think they're getting a lot of pushback from their line lenders. So lenders are being a lot tougher on borrowers.
Hmm.
And even lenders before that you have relationships with, I think if they've given you extensions, I think they've kicked that can as far as they can. And they're going to make you transact, whether it's a recap, a refi, or sell. They want that loan off the books. I agree with you that there is distress in the market, but we haven't been able to find that many opportunities, right? I think by the time that we get our hands on a deal, we underwrite based on our underwriting, the price that we're coming up with is not something where lenders want to transact. So there hasn't been that many transactions yet. But you are starting to hear about certain lenders selling portfolios at discounts and other deals, which could be interesting. We just haven't seen that many deals come through our door yet that have been a fit. But I think you're going to start seeing that for sure.
Yeah, I think I think we have seen some that maybe are a little bit older vintage, um, 70s, 80s. I think once it starts getting 90s and newer, there's a lot more rescue capital out there that's kind of saving those deals before it starts hitting the market and being sold. And I also think it's geographically, right? The ones that got hit harder operationally, like in Atlanta, I think you're seeing a lot more than that than in Miami. We haven't even seen any distress really. So I think geographically it's starting to play out where some markets have a little bit more of a wave of distress, whereas some other markets might have one-offs here and there.
Yeah.
Yeah. I think the distress that we're seeing right now, and I'm sure you'd agree with this, is when the broker calls and say, "Hey, listen, we just need to sell this at the loan basis."
Yeah,
We've got a lot of those calls,
yeah.
and I've probably worked on 5 or 6 of those in the last month and a half.
Mhm.
So that seems to be where the distress is it's like a owner slash lender managed sale. That's the distress. I am hearing of some NPL portfolios starting to move around, so we'll see what happens with that. But for right now, as we sit here today, that's where I'm seeing distress.
But even on those deals that we've looked at and we've underwrote, we end up coming up a little short of the loan basis and the lender's not willing to transact,
Yeah.
right? They're like, not yet, and we don't want to take a haircut on the loan. So you might bid par on a loan because that's what the property is worth based on our numbers. And then when you really dig deep into it, and you get your third party vendors out
Yep.
there, and you realize, okay, we actually have to spend some more money on capital improvements. Now you're at 90 cents on the dollar, 85, and the lender's not willing to transact.
Yeah, it's almost like the parties shift, right? When before when you were maybe at or above the loan amount, you were kind of talking to the owner. Once you start going through the numbers and go through the capex and you see maybe it's worth below the loan basis, it's out of the seller's control. And sometimes it takes a little bit of time and just hanging around the hoop to get the right decision makers to get off and move and make a move and capitulate to where the real pricing is.
Or you and I have seen on deals that we looked at, in Charlotte and other stuff where lenders, our bids are below kind of loan amounts, and lenders were offering creative financing
Yeah.
to borrowers to offset that price, right? Where they said maybe instead of go out and get a new bridge loan, we'll give you 90% seller carry financing at lower spread than market, which gives you the ability to get closer to par.
Yeah, and the problem with those deals is you underwrite them and you realize it's gonna be very hard to take out that loan at some point for some of those deals. They're and if you don't get the runway, like if they're only giving you that for 2 years or 3 years, you just don't wanna end up in the same exact position that the seller's in. So, I think those have been tough. We've seen a lot of those, but where the lender is willing to work and give you, inside pricing, but they just make it tougher on the takeout loan because you can't really move the NOI to a yield where it's acceptable to take it out. Not with all the supply like in Charlotte, not with some of the collection issues. So when you're trying to be conservative operationally, that takeout loan is going to be much harder, even with a little bit of rent growth.
Yeah.
So, do you guys think investors have been a little bit more receptive to coming to the table on in new investments now that we're kind of quote unquote on the bottom? Do you think there's been a shift of investor appetite? And I'm not talking about the JVs, I'm talking about our high net worth family office space of over 1,600 active investors. Do you think those groups are starting to get more intrigued on deals that we're working on?
I think the smart ones are.
Yeah.
Yeah. Listen, it's been a rough cycle. It's been a horrible downturn. A lot of people have been beyond just us and our own investors. We have investors that invest with all different kinds of sponsors. They met them on CrowdStreet or they met them, and everyone's been capital called to death, right? So a lot of people are very fatigued and they've lost confidence in the industry and their sponsors, and they see that the S&P 500 has been ripping for the past few years, and money's liquid, daily liquidity, right? Like
Yeah.
they made a 25% return last year. They want to cash out and go buy a boat. God bless,
Yeah.
right? So it becomes very hard to raise capital in this kind of an environment. But the ones who are really smart and have the foresight, they're going to invest. Somebody reminded me a couple days ago that I think it was during a pod or something. I said that Fieldstone Glen was going to be the last 6.25 cap of this cycle with that vintage and that asset quality. And I was probably right.
Yeah.
Right. So our investors, if you're listening to this, you were smart. Our investors who invested in that were really smart. '03 vintage, beautiful asset, 6.25 cap. We rate locked mid-September when the 5-year was at 3.5. We got low 5% money with a 6.25 cap, and everyone's going to do great on that. So I would say the same thing for today. Anything you buy right now, especially in a more contrarian bet, don't buy in Columbus. In a more contrarian bet, you're going to do great.
Yeah.
Over the next 5, 7, 10 years, real estate's a long-term play. This 18 to 24-month BS, that's not real estate. Over a long-term play, you're going to do great.
Yeah, and I would say to add to that, it's not gonna scream off the page on an IRR, right? Buying at a 6.25 cap and, getting a low 5 rate, it looks great from a yield perspective, but with our assumptions and reverting at a similar cap rate than what you're buying at, it's not going to scream off the page from an IRR perspective. But you got to see past that. You got to see that this is a time where if you're getting cash flow and things don't compress, you're still cash flowing higher than what a CD would give you or a treasury. And so some of those unsophisticated investors, they're kind of looking at what's on paper, but they don't see the bigger picture of what you're really buying and what the yield is that you're actually buying, like a Fieldstone Glen.
Right.
Yeah.
So another way I think of thinking about that is cap rates are as high as they've been to the GFC. So they're not going to go any higher, right? They're already starting to tick down a bit, which means you can only get so hurt falling out of the first floor window, right? Like you're at the ball. So cap rates aren't going to go much higher. In these models, investors are looking at it like, okay, the sponsor's underwriting, they're buying a 6.25 cap. What was our exit cap that we underwrote there? So we underwrote a 5.75 cap. So they're like, okay, that seems reasonable. That's doable. It's got good cash flow. It's going to make a 17, 18 gross IRR. I'll make it 13, 14, 15, whatever. That sounds good. But what's the upside scenario? Right? The upside scenario is cap rates compress further as interest rates come down, which they will. As we discussed earlier, the US central bank is just a little bit behind the eight ball. Inflation's at 2, neutral rate should be at around 2.5. I'm not saying it's going to 2.5 anytime soon, But over the next few years, that's a possibility. And there's a very good possibility that a lot of these cap rates go back to where they were in 2015, 17, 19, and you're selling it at 4.75, you're going to crush it. So your upside potential is much greater than your downside risk,
Yeah.
given where we are in the cycle. So if you think about it like that, and you do a sensitivity analysis, and we all do, as analysts, as investment analysts, we all like to do a sensitivity analysis to the downside. But what's the sensitivity analysis to the upside? You're going to crush it. Just whoever you're as an LP, if you're listening to this, call one of your sponsors and say, hey, model this for me. Like, what is it? Like this deal that you're showing me at a 5.75 exit cap. What if it's a 5?
Yeah.
And look at what your upside potential is.
Yeah. I think a lot of LPs, they get a little bit too trapped in the numbers, right? And as
Big
we
part.
yeah, and we do as well. I mean, trying to protect downside, and I think seeing past it and seeing like what you're really buying right now in this time and protecting the downside is really the way that you'll be able to win in the long term.
Yep.
Look, we would obviously rather show a lower IRR and exceed expectations, right? You don't want to go the other way
Yeah,
around.
exactly.
I think going back to your point is investors are looking to get back into the market, but the toughest part is for us and buyers is you're competing with discretionary funds.
Mhm.
And these funds understand the value they're getting today buying today's basis. And it's tough, right? Because the money's been raised and they understand like, look, we're gonna do great on a long-term basis and we're getting a great cap rate. And it's tough to compete with these buyers. And that's why I think groups like us who have a great Rolodex of investors, sometimes you're just not able to get to that price because you have these discretionary funds. And that's kind of been the go for all the brokers that try to focus
Yeah,
on discretionary funds.
yeah,
I was just talking to a broker friend of mine in LA, and like the downtown LA market is really interesting because you're starting to see prices per door that you've never seen for, I'm talking about class A, beautiful product. There was a deal recently that Fowler bought from CIM, probably arguably one of the nicest apartment buildings in downtown for 320, 325 a unit. That trade before was closer to 530 or 550 a door. So you're getting amazing value on that deal. And obviously there's risk to it because right now there's a lot of concessions going on in the market. People are giving, 4 to 6 weeks free. A lot of renters are bouncing around. But if you believe in a certain market like LA long term, and downtown, I think will come back, buying a brand new high rise for 325 a door compared to your cost basis,
insane.
it's insane.
Yeah.
You're getting probably arguably the nicest building in downtown.
They might never have supply again.
Yeah, it's honestly the contrarian bet on downtown LA. Listen, we're born and raised in LA. Not trying to say downtown LA is the prettiest place in the world, but there is something to be said when return to office and some of the office, you're seeing the same type of buys on the office side. Some of these guys are buying office and starting to really like attract people to come back to work in downtown LA. I think you're going to see some sort of resurgence. Obviously not going to get back to where people thought it was going to be, but it doesn't need to get all the way there to make a good return on something like that.
That's right.
Yeah, but if you look at downtown LA, the office is a different sector. You're
Yeah.
starting to see a lot of these big office buildings that you should trade for 400, 500 bucks a foot plus. A lot of these guys are buying this stuff for 120 to 130 bucks a foot. And Carrollwood just announced they're buying that new office building. But on the multifamily side, it's kind of like think about the office side of New York, right? The office market is, if you're in Midtown, is really hurting. But if you are class A in New York, you're killing it in office right now because there's a flight to quality. Same thing I think in multifamily
For sure.
downtown.
Yeah.
There's a flight to quality. Like these renters are looking at, if I'm getting 6 weeks free on a brand new unit, they're probably net effective rent per square foot is close to $3 a foot, 325 a foot.
Yep.
Are you kidding me for a brand new high-rise product? Right? So for them, it's like it's a no-brainer. I'll drive a little bit longer than I have to, but I'm getting this beautiful apartment. And
Yeah.
there's a great food scene and there's other stuff downtown offers.
Yeah. So going back to one of your points, you were talking about how discretionary funds competing against them, it just makes it really tough, right? I think one of the strategies that we've found ourselves in is product that for whatever reason the discretionary funds aren't writing on, but is still good quality product. Maybe it's a smaller new vintage deal that's merchant built. Maybe it's a 80s vintage, which it's not 70s, but it's not 90s or 2000s either, and doesn't have that 70s risk. And I think what you're finding is if it doesn't check the box for a discretionary fund, the cap rate expands enormously. I mean, to levels where you're like, this is a no-brainer. I think we're really positioned well for that, given that we have our Rolodex of investors. We have LPs that trust us, that we've performed with during cycles. So I think that's a great place where you can get some really good yield today. And you're getting that good yield because a lot of the institutions, a lot of the capital is still on the sidelines and only buying far and few in between.
Yep, absolutely. I think, look, also the thing about
Fieldstone Glen was, by the way, like one of those deals.
What was it?
Fieldstone Glen was like one of
Yeah.
those deals, early 2000s, but a little bit of a workforce pocket. So maybe didn't check all the boxes. Atlanta's a little out of favor at the time. So yeah, sorry, you were saying?
No, I was just gonna say on downtown LA and something like that. Again, contrarian bet. You're also, I remember Omar once asking me what I thought about a certain trade in downtown LA. And I said, it's not a real estate play, it's a political play, right?
Yeah.
You're betting that the politics are going to change and you're going to have better politics and more competent politics, good leadership, and they'll do what they need to do to clean it up and make it a thriving neighborhood. And when that happens, you'll do great.
Yeah. Okay, guys, last thought. We're halfway into this year. Are you guys feeling more optimistic about this year or less optimistic since starting the year?
I was hoping that things would start to turn a little sooner in the year, and it looks like it's probably going to resemble last year,
Mhm.
where it's the football rate cuts, and we'll probably have a summer bond rally with that anticipation, and the market will start to heat up. Like I was talking to one of my friends last summer, it was August. I remember exactly where I was, and he had gotten retraded by a seller. He was buying a deal in Seattle, and the seller said, "Hey, rates just rallied like 75 basis points as we're negotiating this PSA. I want more money." And he said, yes.
Wow.
And I think that momentum this year is actually going to stick. The volatility will start to go away. We're not going to see bond yields go down 100 basis points, up 100 basis points. You'll still have volatility, but not to that degree. And I think with that, the markets are going to improve. Supply is falling off a cliff. We're going to see rent growth, and that all happens Q3, Q4 this
Yeah. Mitch, what are your thoughts?
I'm not as optimistic as Max is for Q3, 4. I think you're
I think
I
2026.
think
Yeah.
it's yeah, I think this year's too early. I mean, look, I think that the end of the day is even if we start cutting some rates, those are short-term rates. That's going to help. But I think overall, for values to kind of go back up, people are looking at long-term bonds, right?
Yeah.
5, 7, and especially 10-year bonds. So with all this volatility, I just don't see bonds going back down to a point where values go back up. And I think it's going to stay like this for the full year. So I'm thinking about next year in terms of the market coming back.
Yeah, I also think operationally, nationally, you're gonna see 2026, the year where summer of 2026, leasing season, peak leasing season for money markets. The supply will be absorbed by then. You'll start to see some positive trade outs nationwide. You're already starting to see it in some markets. So I think 2026 is like the operational year where things get much better, and you'll start to see that lead to some better transactions.
Yeah. I'm more concerned about, operations in terms of when the market was great, obviously values were great, but when the market was great, you were running, EGI in the, low to mid 90s, right?
Yeah.
Because, delinquency was 0.5% to 1. There were no concessions. Everybody was paying rent on time. And now in some of these markets, if you really look at your EGI and you take away everything, you really kind of strip out everything, you're running a low 80s between vacancy,
Yeah.
concessions, delinquency. You've never seen this. And when you start looking at those numbers and then you start adding on top, insurance went through the roof, right? You're paying higher for payroll now. Operationally, it's been a challenge, but I think you're finally starting to see that start correct itself, right? I think overall occupancies are starting to go up. Supply is obviously falling off a cliff, and I'm hoping the market's going to recover operationally.
I agree. Operations have been brutal the bad debt, the concessions, the economic vacancy has just been absolutely
Some markets worse than others, but yeah, overall, right? Like, as you said, like, West Coast might be a little bit better.
right.
I mean, Colorado's been brutal. I was just talking to a Colorado broker a couple days ago, and they were just saying how it's been extremely painful to even BOV things because you get the AR report back and it's just even worse than it was before. And like, it's out of the owner's hands at this point with some of these laws and ordinances, and people are stretched thin. That's the bottom line. People are stretched thin. So hopefully better year ahead, and we'll survive. And yeah, thanks for hopping on the pod, guys.
We all know one thing. If the real estate market doesn't get better, I think you found yourself a great new friends. Timo the podcaster.
Yeah,
You got everything set up. I'm getting great reviews.
you got to diversify the revenue stream somehow, you know? Yes, exactly.
Timo Rogan. Say for you.
Felipe and Andrew call me Jew Rogan, so
Rogan.
we'll do something like that. But guys, always amazing having you. Hopefully we can make it recurring, but this was great.
Awesome.
Appreciate it.
Thank you.
Thanks.